All right, good evening, everybody. I think you should be able to hear me. Just quickly give me a thumbs up or a yes or a no duh, Keeve, whatever it is. Let me know I'm being heard real quick. All right, thank you. Perfect. Guys, welcome, and ladies, welcome to the Hurley Investments Trade Findings and Adjustments for April 6th, 2021. So to start off, you probably, if you were here last week, probably heard Kevin say something to the effect of, yeah, the market is a bit, a lot of things, I guess I should say, up in the air, and not the best time to be putting new money to work. But with that said, I do want to go over a couple things and just kind of look at some thoughts and ideas. I have also got a PDF here I got from Fisher Investments. These guys are always on doing their ads on CNBC. You may have remembered the owner. I can't remember his first name, but Fisher said some oopsies that pissed a lot of people off, and now he's no longer in the commercials. They got some actor in there. I think he said something to the effect of to his, advisors that they got to treat clients like they're a girl at the bar that they're trying to get into bed. And obviously, or I should say for obvious reasons, that was not received very well by many people. So a bunch of people pulled their million. I think they had 3 billion in assets that were pulled out of. Pretty crazy. But I thought this six pitfalls of mutual funds was interesting. There's some good information in here that would be worth looking at, especially if you've got some friends or family that have advisors doing the mutual fund thing. And why on earth, why would you want to do that? So we'll look over that. Did want to look at, follow up with yesterday, talked about the market and where it could end in April, being up there around, I kind of went ridiculous numbers and threw out 5%. Maybe that's a little optimistic. But I think if we have some good pre-earnings runs, it could end that way. I think some of the things that might get in the way might be some tax selling. They moved that out to May 15th, I think, similar to what they did last year, moving it out to June. And so I think our tax selling may come closer to the end or beginning of end of April, beginning of May. That could throw a wrench in the spokes, so to speak. But I did see a little blurb from, I can't remember his name. I need to look it up. One of the guys they were interviewing on CNBC yesterday, who argued that there could be a ridiculous 3% upside getting the market up to 4,200. So way up here by the end of April. Just scrolling through my phone, trying to see if they had that up still. Probably should have just been smart and saved it, but some fund manager of some type was putting that out there. So not not the only one thinking that. So you might be thinking, well, but Kevin just said last week that this is maybe not the best month to be looking to put on new money and make trades. But my response is that that's true too. Um, I think that what we have is fantastic to be letting things go, and um, we can certainly manage things if it turns around. But um, that's kind of my take so far. Just um, a lot of things that are unsure. I think Ida, you mentioned yesterday people uh, maybe refusing to take the vaccine. That's a point to consider. I think you also mentioned possible shutdowns like Europe is having, although I don't think they're having as much success in the way of vaccines over there as we're having here. We're doing, correct me if I'm wrong, Ida, but I think we're doing pretty good. Of about a third of the population here vaccinated. Um, I also saw many of the new hospitalizations are younger people, and it's the rate of older folks having to go to the hospital is coming down significantly. So, with older population obviously being higher at risk, that's definitely a positive. So, anyways, I still think we will see continued run up for pre-earnings run, and I guess we'll see after earnings where things go next. That's going to be the biggest thing, and in the next um, week, uh, for some stocks like our bank stocks, we either have to roll out or roll up some of the protection. I talked about Bank of America and what I'm looking at there. And I did mention, if I can actually type correctly, Baidu as somewhere that I can get some money to work just because it's pulled back so much. But over the next week to get our bank stocks, if we need to on JP Morgan, I think we're set, but Bank of America, we'll run out of time on our current puts that we have, and they're out of the money that we'll need to roll out and up closer to 40 and get those protected, as well as the next couple weeks, the rest of the stock positions and holdings, such as, let me see, get our portfolio up here just so we can, mainly Apple, looking to find probably closer to next week where we might need to look for protection. Just to take a look. Yep, so end of the month. So sometime in the next couple weeks, I would say, for something like Apple. And so I'm just going to be going through and simply looking up each of these positions, taking a look on if it's confirmed, which this is great that E-Trade has this feature telling us whether the date is confirmed or not, so that we know if we have to keep checking. And what I'll usually do is just go down the list. I'll have Apple written out, have my date set, put it in my iCalendar. I'm an iPhone user, so that's kind of my deal. Kevin likes to do the old school paper route, which works for him. I like to put in a reminder a couple weeks before, as well as a couple days before, for my phone to remind me that these earnings are coming up. So I'll just go down the list. Apple, we know, is confirmed, so I'll go on to 428 and I'll put a little Apple ticker symbol as well as AMC next to it. Not only just telling me that it's aftermarket close, but if this was not a confirmed date, I would leave the ticker symbol and nothing AMC or before market close BMC next to it. That way I know whether or not it's confirmed. Putting this note on the next to the ticker symbol lets me know whether I've checked if it's confirmed. So I'll just go down the list. Apple, got a note here, Ida. I'm just going to read exactly what you're saying. That way people know rather than trying to paraphrase. On COVID, please remember that I am Canadian, so hesitate to comment. However, in our city, we are watchful about the virulence of the variants from UK, South Africa, Brazil, and the science is new. So anybody's guess is as good as the other person's. Gotcha. Now, I did see that there is some decent effectiveness with the current vaccine on those other strains. And I really haven't heard a lot as far as in the US that these other strains are making huge headway that isn't being handled, at least by current restrictions and also vaccines, but yes. Always something to consider. Let me just continue to go down with our main positions. Boeing. Looking at same day, there's going to be a lot on 428, it looks like. But this is estimated. I'll just put BA with nothing next to it. And go from there. Bank of America, I know, is, I think, the 15th. So go up to your quote. 15th confirmed. And just check out our main holdings right now. You can click on any of these. Ours is kind of ridiculous, obviously. Still estimated. This isn't for a while, so Baidu will just put a note and keep checking back every few days. And then I'll look at Disney and Visa. Disney, Under Armour, Visa. Those are the main ones I'm looking at and worried about. This week, let's see, 513 confirmed. So I'll put Disney with an AMC next to it. Wanted to go down to Under Armour real quick and Visa just to check. We're out in May 10th, estimated on Under Armour. Visa 429 estimated. So I wouldn't be surprised if Visas came out on the 28th when it's confirmed. They're usually pretty close to Apple. But that is what I do. But I just wanted to point out those 4 or 5 as the ones that are particularly on our mind, just because they're our largest positions. So Bank of America, let me take a look at. So I thought I would wait until and see if it wouldn't get closer to $40.50, closer up to 40.75 where this R1 pivot point is. Kind of look crappy today, but still in a bullish trend, so I didn't think too much of it. Why is it down today? You may have seen which one was it? I think it was Goldman Sachs. No, it wasn't Goldman Sachs. Trying to remember which big firm kind of got stuck with a bunch of that Archegos hedge fund having to cover their shorts on Baidu or cover their margin on Baidu. Can't remember off the top of my head, but that is one thing that was dragging down banks. Let's see, did somebody help me out? Swiss Bank. Thanks, Bill. Knew one of you would have it. What is that? UBS? No? Pretty sure it was UBS. They don't look bad today, unless I've got my ticker symbols wrong. But yes, it was UBS. But when I was looking at that in relation to other banks and specifically Bank of America, JP Morgan, didn't really see a huge reaction, so I didn't see any reason to think that it was a big deal for us. So I'm still keeping my eye open for when we could take these Bank of America. We have 38 puts, 38 strike puts expire next week, or sorry, the week after next, which doesn't give us tons of time. No, that's next week. What am I thinking? Yep, because next week is the third Friday, so you only get one day before expiration on these April 38 puts. So we have to look at rolling those up and out. I'd like to get somewhere closer to 40, something like that, and I might consider going something like May 14th or May 7th, probably closer to 14th just because more time, and saving the 30 cents we still have and going up for better protection and going from there. So that is what I'm looking at. Prorotection is not a word, neither is portection. There we go. And for $40 a share. Got it. We're making progress. All right. Baidu. Again, this is strictly if you really don't have any Baidu, or yeah, that's pretty much it. If you have Baidu and you've enjoyed some of this nice run up, this is not for you. You really don't need to worry about it. Just enjoy what we've done with Baidu so far. But at some point in here, I don't see a problem with adding a leap Baidu call. So I'll say for new positions only, do the following. And I would really just look at going out to June 23, somewhere around 300. You see all these little flags. That's because we just have so many different positions for Baidu. So I was looking at something like a 300, 400. It's pretty cheap as far as leaps go. Your 400 pays for half of the premium, basically. And for the next 2 years, you can make up to $100 between those two strikes of 300 and 400 on a Baidu Leap Bull call. If you have plenty of cash and not a lot of positions that you also need to have cash for at dollar cost average, then certainly don't have to add the short, but I mean, check this out. Not the quantity assistant. Let's see. 5 rewards for 1 risk. That is pretty cool. Definitely don't do 10 contracts. And I would just trade it the same as just one leap long call without a short. If it goes down, just dollar cost average. If you're half off of your debit price, right? Your premium cost, and go from there. Just take a quick picture here. I hope none of you are sick of me talking about Baidu, but Mercy, what? It just keeps giving us opportunity, and it's opportunity both ways. Made a lot going up, made a lot going down, lowered our risk, our cost basis, added shares. Once again, it's just beautiful. So that's what I would look at if I were looking for a new position to put on in this coming week and days. There it is. You could go closer to the money. That is just simply a question of risk for you. You could do something like a 250, 350. Just going to cost a little more. So that's what I would be looking at. Questions or thoughts on that? Baidu could be our stock that really makes our year. It could be Apple getting back up to 145 and heading up to 175. It could be an Under Armour going up to 40. It could be a Disney heading up closer to 300 with their parks opening. There's still tons of potential in the stuff we already have, and that's why we keep it. So very cool. Just to go over this article a little bit, are funds right for you? Some funds can be effective investing tools, but they aren't a strategy on their own. Investors must make sure their asset types, and investment risk mesh with their long-term goals. That said, funds can offer some advantages and give smaller portfolios the ability to build out a cost-effective, diversified portfolios. I imagine they're saying this because the irony is they have their own funds. Fisher Investment has their own, Fisher investment funds that they probably put all these smaller guys into. So they're trying to kind of look at some people with over 500 to invest, 500K to invest. You really don't. Well, I'll just read it. Mutual fund fees can be more expensive than trading costs investors would incur by owning the fund's underlying holdings directly. Further, some funds may not provide personalization required to meet investors' long-term goals. And it's funny because we hear a lot of that type of marketing, like, does your advisor really put together a portfolio that is specifically tailored to you and your needs? And it's a nice little marketing slogan or marketing point that then is just typically not filled to any real degree in real life. They get your money, they throw it in their funds that they get their kickbacks on, and that's pretty much it. Funds are typically designed for a broad audience and invest based on a prospectus or management style of a fund manager. Rarely does everyone invested in a particular fund have the same personal situation and financial goals. Pitfall number 1, diversification gone wrong. Isn't that the truth? Generally, diversification benefits investors, which is one of the primary reasons people buy various funds. However, funds can cause over-diversification if not applied carefully in a portfolio. Well, yeah, especially when you see funds that own other funds. Give me a break, right? On average, U.S. mutual funds own about 295 securities, so owning 10 funds could mean having stakes in as many as 22,950 securities or more. Exposure to so many stocks can make even matching the performance of the overall market difficult once fees are taken into account. Over-concentration in certain sectors. This one is kind of, I would make it different point, but yes, obviously it's over-diversification, but really you can get the same over-diversification with any mutual fund, even if it's the S&P SPY ETF itself. Why? Well, you see how many of our core holdings there are. You see a bunch of these. A lot of these are just some small positions that some clients like to have in their own accounts that they're trading themselves, and we just see everything. So don't be confused why I'm saying, you really don't need 100 different stocks in your portfolio, because when we have all accounts here, this is a mix of a bunch of stuff, and some of it is smaller positions that are being that are in some accounts that we're not really managing. But the bulk of our stuff is in just a handful of shares. And the way we tailor that to an individual investor obviously has to do with how much money they have. It has to do with personal preference. Some people couldn't care less about the opportunity in Baidu. They don't want a Chinese stock in there for whatever reason. And that's fine. And we go with that. We take care of people. But the biggest way we individualize it is by getting to know you personally and getting an understanding of your risk profile and preference, so that we know if we need to be more often protected with puts or covered call situations. I may look at adding a Visa with a long-term covered call that we can just have some protection out there, don't need to have every bit of the upside, and we can not have to pay so much for puts and just roll with that. That gives a little more, for someone that is a little more risk averse, a little bit more peace of mind, a little less volatility in their account. So there's a bunch of little things we can do, even if we have many of the same positions for different accounts and clients, that we can personalize it. Why? And you've heard Kevin go on about this quite often, and that is just simply that diversification did not protect anybody from the 2008 crash, didn't protect anybody last year for the COVID crash. Any big sell-off and crash you can name, diversification didn't really help. They might have had, I don't know, oil or something that something in oil during 2008 that later took off, whatever it is, but it certainly didn't protect. It hedged a little, but it didn't protect. And that's why my view of the diversification is even a little more simple than this. Yes, you can be way over diversified, but honestly, the main point is that diversification was never protection. Everything goes down when there's a big event of risk, a big event that causes a huge amount of selling and fear. Nobody knows what to think in those situations. That's just the way it is. So, pitfall number 2, I kind of went over this because it was talked about in that first paragraph, lack of personalizations. Many funds tend to follow strict mandates, such as investing in an asset in a set portfolio allocation or in a specific style. That's kind of part of the bummer of regulatory issues that these mutual funds have, specifically that they have to do what the prospectus tells and doesn't leave them with a lot of room for using brains. They've got to sell off winners and losers every quarter, every month to keep things balanced, etc., etc. That really doesn't help. It doesn't really help with regard to personalization, and it doesn't really help with regard to, again, going back to protection. Number 3, potential for increased behavioral mistakes. Even the smartest people can fall prey to emotion investing, which can lead to trading too often and at the wrong times. Behavioral errors like these can result in some of the most significant investing errors. Of course, funds alone don't cause behavioral errors, but investors may be more likely to make mistakes due to recent fund developments, including intraday trading and the use of funds in passive investing. This is one area in which investors can benefit immensely from having an investment advisor who can help them stay on the path to their goals. So, yes, few things make me more upset than advisors pitching, oh, the most conservative thing and just conservative and what's another way to put it? Another tried and true method of investing is passive investing. You can avoid the pitfalls of what they're saying, behavioral mistakes, by just sticking with passive investing. So let me get this straight. You're paying an advisor to put you in a bunch of funds and telling you you're passively investing. And this is where I'm going to be a little bit critical, because they're saying, funds managers can make behavioral mistakes, which is true for anybody, including Kevin and I, making behavioral mistakes. The problem is a lot of advisors are simply passing off what they have you in for your portfolio as a passive investing, even though they're in a bunch of mutual funds. Oh, well, it's the best thing is to just passively invest in the indexes, and maybe you'll have if you're closer to retirement or in retirement, they'll say, okay, well, let's do a 60-40 split, 60% stocks, 40% bonds. And, you know, we avoid a lot of the behavioral mistakes because we're just being passive. When in reality, they don't just have you in one bond ETF and one SPY to get you into the market. That obviously you could do on your own. You wouldn't need to pay a percent to have someone manage your money if you were truly passively investing in the market. But they don't. They put you into a bunch of different stuff, and they're all funds that attempt to follow the market. Those funds, of course, have all of their fees, which I hope they get to. But yes, not many things frustrate me more than advisors pitching a passive investing style that when all is said and done, they really don't need you to charge them if they want to truly do passive indexing. Bothers me to no end. All right, talk some more about behavioral mistakes. The difference with behavioral mistakes with a mutual fund and behavioral mistakes with Hurley investments is we don't pretend we can pick all of the different stocks that are going to go up all the time. We protect. We know that 84% of the time stocks are going to move 10% or more on their earnings. We protect for their earnings no matter what, because we can't outguess the market. It's not a repeatable process to always try and find the best group of stocks, the best sectors that are going to move. It's kind of ironic. A couple of years ago, a good example is Bank of America and bank stocks. From a couple of years ago, Kevin and I were like, all right, this is great. Bank stocks are the thing because interest rates are going up at the time. This will be great. Bank stocks kind of sucked for a while. They didn't go up. Nobody believed that, or nobody really bought into that idea based on the interest rates going up. Don't ask me why, kind of dumb. The housing market now is going crazy, so that's the difference now. But you also have everybody talking about bank stocks now because, hey, interest rates are going to go up at some point. We got to have some bank stocks. And me and Kevin look at each other like, wait a minute. I thought that was the idea a couple years ago, 17 and 18. Interest rates were going up. Nobody really cared about it. But now all of a sudden, bank stocks, good, interest rates are going up. So I guess my point is you never know whether it's a good reason or a stupid reason that the market does what it does. Doesn't always do what you think and what you want. So why on earth are you trying to outguess the market? I think I've said what I wanted to point out in this. Tax disadvantages. Capital gains in a mutual fund are distributed to individual shareholders of the fund. End up paying taxes on these gains in a year in which you don't sell any shares yourself, or even when the overall fund incurs a loss. Some of these include ETFs, so you got to be careful if you're doing something with an ETF that it's not like an ETN or a K1 style ETF that could put you at a loss or to owe taxes on the gains of the ETF because it doesn't matter if you sold at a loss. The K1 says that ETF over the course of that year, that tax year, was profitable. You pay taxes on that, not what your cost basis was. That's all they're saying. And that doesn't even go into the problem of mutual funds being businesses that have to pay taxes themselves. Doesn't matter if you have an IRA with that you're investing in a fund for. They are mutual funds are companies. They have an EIN number, they pay taxes, and they do it out of your gains. So, you guys are welcome to look this up. It's at least some decent information. It is kind of ironic because they are just trying to then tell you, oh, well, you should invest in our mutual funds because they're special. They're pretty and special and have all these same problems. Yeah, they're just trying to get people with more than 500,000 to put money with them and put it into stocks instead of a bunch of mutual funds. So that's all that. But interesting to look at. Not a bad article. Again, that's Fisher Investments. Check it out, or I can send you the PDF if you're interested. But that's really all I had for you guys tonight. Thank you all for joining me. And other than that, I'm just here to answer questions. Anybody has any, shoot them off now. William, yes, so Kevin is shooting to be back for the Thursday trade findings. He's hoping to be back. Talked with him this morning. He sounds good despite a couple coughs and sneezes here and there. But he is looking to be back for Thursday morning trade findings. Any other questions, guys? No problem, Abraham. Thank you. And Ida, thanks for your comments earlier. Appreciate that. No problem, Jim. Thank you, guys. I think that's it. I'm not seeing any other questions. Appreciate you being with me. Have a good night, and I will be listening in to Kevin Thursday unless he tells me otherwise. So I look forward to seeing you there. Take care.